In 2018, we invested some of your money in ABB, which is a Swiss-Swedish engineering group. Looking at the company, you may be wondering what we had in mind. This is a company which has seen its growth rates collapse. It was growing 10 years ago at 10 or 15% a year. Now it's growing at 0 to 5. It's a company which has also seen a big drop in its profitability. It was recording EBITDA margins back then of 17, 18%. Now it's more like 10 or 11%. It looks, in other words, like a company past its sell-by date. So what were we thinking of? Well, to understand what we were thinking of, you need to wind the clock back a bit further. Go back to 2001. In 2001, news broke that ABB had a liability to asbestos litigation as a result of a company they'd bought in the States some 10 years previously. By 2002, the company was in a full-blown crisis, and by 2003, they had to issue new shares to cover a growing black hole on their balance sheet. Now, this was a company which had been run mostly by Swedes and where the boardroom had been dominated by Swedes as well, in particular Sweden's Wallenberg family. But in connection with this crisis, the Swedes were pushed out and a group of mostly Swiss managers and Swiss shareholders really took over. Finances were pretty strained, as you can imagine, and they tried to cut spending wherever they could, including R&D. Now, fast forward 10 years. By 2010, 11, 12, the company was reporting pricing pressure on all its key products in all its key markets. Now, our analysis is that that was their fault. If you stop spending money on your products, it's just a matter of time until your customers call up and say, I want a discount. But at the time, they had a chairman who was a veteran of the automotive industry, and the automotive industry has only one solution to most problems, and that is cut cost even more. So he cut cost even more. And I think ABB went into a vicious circle. They had less money to spend, they spent less money, they had to offer more discounts, they spent less money, they had to offer more discounts. Often when we're looking at industrial companies, we find that because they're in fairly slow-moving end markets, what's going on inside the company can change the medium-term outcomes much more than what's going on outside the company. And so it's been with ABB. We think ABB turned an important corner in 2015. That's when the balance in the boardroom started to tip back in favor of the Swedes. In that year, a company called Cevian, a Swedish activist investor, acquired a big stake. And coincidentally, there was a change of chairman that year as well. A former CFO called Peter Vosa took over, who, in our opinion, is a big improvement on his predecessor. By 2018, under pressure from investors, ABB had agreed to sell its biggest single business to Hitachi of Japan. And that's a sale which is in fact only just closed. It closed in July of this year and is right now financing a $7.8 billion buyback program. That's about 14% of ABB's market capitalization. As of the start of this year as well, ABB has a new chief executive in the form of Björn Rosengren, and we know Björn Rosengren quite well. He has a track record from Atlas Copco, from companies like Wärtsilä, which he ran for a few years, and Sandvik, which he ran for a few years, and his track record is very strong. Under Rosengren, we think that ABB can significantly improve its growth rates, significantly improve its margins, and for sure, improve its cash flow. If you look at listed peers to ABB, the closest we think is probably Emerson Electric, which is an American company. ABB's margin gap to Emerson is 7 or 8 percentage points. And improving the margin, of course, would work wonders for cash flow. Last year, free cash flow was about $1.6 billion. We think it could rise to $3 billion or more over the medium term, nearly doubling. We think that if ABB can only maintain growth rates at historical levels and not even see any reacceleration, but could close half of that margin gap to Emerson, then the company would be worth something like 30 Swiss francs per share. That's 25 to 30% more than it's currently trading at, and it's over 50% more than where we bought the stock back in 2018.